Welcome, investors. The stock market continues to make all-time highs while the inflation rates continues to decelerate. But what are the insiders doing? The ones that have access to information that you and I do not. I'm Jake Ackerman, your investment advisor representative, and let's get into it. All right, so first, I want to share some recent articles with you. All right, so insiders at FedEx sold $1.6 million in stock. Insiders at Lowe's sold $1.5 million in stock. Insiders at Cactus sold $100 million in stock. Insiders at Merck sold $12 million in stock. Stryker insiders sell $110 million in stock. Insiders at United Healthcare Group sold $15 million in stock. Monster Beverage sells $62 million insiders. Stead Group insiders sold $8 million in shares. Insiders at McDonald's sold $7.6 million in shares, alluding to potential weakness. So first off, who are the insiders? Insiders are your CEOs, your chief financial officers, your chief operating officers, chief investment officers, executive board members, people that have access to interworkings of the corporation, the financials. They have access to information that the employees don't have, that you and I do not have. So they know how the business is operating, and whether it's, does business look like it's picking up? Does business look like it's slowing down? So reading the writing on the wall of what these people are doing can give us some insights of what may play out in that company, or if we see a trend in many companies, what is the broader market doing? So we see lots of insiders selling right now. Do we take that as a warning sign where, hey, the whole economy is slowing down? Maybe. Or we just had an epic rally, a historic rally since October 2023 all the way until July 2024. And these insiders are just saying, wow, our shares are just really overvalued. We need to book in some profit. So there's two sides of the coin that could be that either one of those scenarios could be taking place. So it's just something that we need to be aware of, and it's a warning right now, at least for the short term. Insiders believe that their company's stock is overvalued, and will this broaden out? Time is going to tell us, but these are just notes. Again, we're professional investors. We're moving odds and the favorability of our investments into our side. We want to be the house if we were at a casino, not the person going to gamble at the casino. The house always wins. So we try to move the odds in our favor and just take note of that. What else is happening? So this is an article earlier this year, the great cash out. Jeff Bezos, Leon Black, Jamie Dimon, the Walton family have now sold a combined $11 billion in stock. Warren Buffett tells Berkshire Hathaway cash pile is nearing $200 billion. So not only are these people insiders, but they have an amass amount of wealth. And they have access not only to the interworkings of their businesses, but businesses all over the world. So they have their hand on the pulse of the economy. So it's something that we need to take further note of. Not only are they selling their own stock, but they know things that you and I, again, do not know. And they have resources, people, staff members, employees all over the world positioned. Think Asia, Europe, Canada, Mexico. So they have knowledge that what's going on in those different economies is not only just the U.S. economy. So those articles were earlier on this year. So the first one, $11 billion in stock, I think that was an end of February article. We don't even know what's taken place over the last quarter. That's just what's reported right now. I know there's been at least another $2 billion in stock from those major ultra high net worth billionaires. So we eventually will get more reporting on them. There's ways to kind of float under the radar with what they're selling. They can space it out where they don't necessarily have to report some of their shares that are being sold. And they may not sell their own shares. They could be selling shares of other businesses. So there's a lot of little fine-tuned rules. Generally, when they go to sell shares, since they're such major owners, we do get notification of it. So look for maybe more reporting in the future. Warren Buffett, perhaps one of the best investors of all time, averaged nearly 20% return in the markets over the last 20 years. So even with the great financial crisis, the dot-com bubbles, nasty recessions, Warren Buffett has generally come out on top because he follows fundamental rules that have kept him out of trouble, and he does not chase the next hype. He just follows core principles, core investment philosophy, and that's why he's so successful. So when he's doing things, he's a value trader. He does not like to buy things when companies are overvalued, so he will wait. Positioning himself a large cash pile is an investment for Warren Buffett. So he'll go out and buy T-bills or short-term money market funds or short-term bills to get a high percentage return risk-free. So that's what he likes to do. So he'll sit in the sidelines. It's just something else we can move in our camp to take note of. So we have these insiders selling. We have inflation coming down. And we have inflation coming down. What's my next slide? We have inflation coming down, and we have some warning signs, but we're also getting still decent job numbers. But do note, when you peel through, or when you lift the hood of the jobs numbers, a lot of them are just government hires, healthcare, and some lagging sectors that are just really pushing up the jobs numbers. And something that I recently seen regarding the state budgets, these states are going to really slow down their spending. They are planning to do budget cuts. However, it's just going to take place after the election. So look for those padded numbers, padded jobs numbers from the government hiring to really start to slow down here. So we need private sector to pick back up in order to account for the slowdown in the public sector, government jobs. Will we get that? I don't really think so. I think things are still slowing down, but could we somehow navigate this soft landing? Possibly, but we're just at the beginning phases and are just starting to see things slow down. We're in the early phase, early innings. I want to share the economic output chart so we can gauge in our minds, what's happening. And again, potentially we do get a soft landing. If we go through history, it's just not odds-on favorite. So what I have here for you is the manufacturing index. So economic output coming from the manufacturing sector. So your warehouses, your builders, the companies that are supplying the Walmarts and Targets of this world, or auto stores. So the 50 line is decrease in economic activity. It's negative. 2008, 2009 we've seen one. 2016 we've seen it drop below 50. 2019, 2020 obviously dropped below 50, and then we're also negative right now, declining. However, we're starting to come back up, so see in a couple months. This is the services sector, economic activity from the services, 2008, 2009 negative, 2020 negative. Services is generally well above 50, but now we are below that 50 mark, so we're in contraction and slowing down in the services sector. So given that, why is the market making all-time highs? When you have insiders selling, billionaires selling, and the economy slowing down. Well, the markets are forward-looking, and they're starting to price in, more certainty around the presidential election, more certainty around the timing of the rate cut. If you take a look at the probabilities of a rate cut, this is the CME Watch tool. If you look in September, we got a 93.5% of this is what the betting market is saying, of a rate cut here. The first rate cut will take place in September's meeting. So there's more certainty coming to play right now, and these events haven't taken place, but the market likes more certainty. So it'll price in things before they're happening, and then we have these insiders selling, and we have a lot of retail exuberance. You think your friends, your neighbors, your family members, they're known as retail traders. Well, they're piling in because they missed a lot of this train, and they're getting calls from their friends and family who are making a lot of money saying, hey, are you buying this? So they're all jumping in. So we're seeing big money selling to retail traders. And I can't tell you how many calls that I got from a lot of my retail clients talking about the stock market. And usually when we get a lot of clients calling us, talking about the stock market, wanting to know what's going on, it's usually signs of either a top of the market because people have fear of missing out. Hey, did you get in? What's going on? But that's usually the worst time to buy. And then you have the opposite side, which is the fear, max fear, when things are really hitting the fan. We are in a really nasty market storm. You get lots of calls. Oh my gosh, things are terrible. Are we selling everything? And generally, that's not what we want to do. We want to be doing the opposite of the max emotions right now. And that's what the institutions are really good at, bypassing the emotions and just doing what's fundamentally right. So if you're not in right now, patience, things are coming. Now I want to move on to the last phase of our presentation here, or our recording here, last phase of this video. And when do we know when we're coming out of this? When do we know whether we've achieved a soft landing or not? And think of the economy as a giant aircraft coming down, and the Fed is trying to balance this on a 2-foot runway. The tire's 2 feet wide, and they're trying to balance on a perfect 2 feet runway. Can this happen? Sure. Is it likely? Probably not through history. It's just very, very difficult to do this balancing act of slowing down the economy while avoiding a recession, and then bringing down the economy, slowing down the economy enough where it brings down inflation. Very challenging. And think of this runway, it has some bumps, rocks on the side, and that would be maybe a mild recession or just a bear market or slowdown. And on the other side of this runway is a cliff. Hard landing, things are breaking, and we don't know which side of that runway we may fall on until we're actually in the process of slowing down. So 2008, 2009 could have been a soft landing, but you had massive bankruptcies, bank failures, so additional things that happened during the economic slowdown. How can we tell if we're having a soft landing or we avoided a really nasty recession? And I think it's pretty clear if we go through history, and we can take a look at the inverted yield curve. What is the inverted yield curve? That means the longer term yields. So think of a line, and I'm referring to bonds, treasury, debt securities. If you are the bond purchaser, the purchaser of the treasuries, the longer that you buy this for, you should get paid more. So if I go in and buy a 30-year treasury and I have to hold this thing for 30 years, I should be compensated more compared to if I went in and bought a 2-year treasury or a 2-year bond. So right now, what happens when we have an inverted yield curve, it's a sign of a sick economy. Banks can't function well because they purchase on a shorter term debt security and lend on the longer term, and they get that difference between the short term and the long term. That's how they make a lot of their money when they do lending. So what happens when we get this inverted yield curve is the shorter term dated debt securities yield higher than the long term, which is not normal, and we only see it when things are going south or things are sick. So let's take a look at this last chart, again the 2-year treasury, and let's go through time and what happens. So that line in the middle is the 0 line. That means the yield is inverted. When the chart is showing the descending where it's coming towards that 0 line, that means the Fed is usually hiking rates. And when it jumps back up above the 0 line, that's the Fed cutting, usually because of weakness. As you can see here, the shaded areas are recessions. So let's go through this. Starts back in the 70s. So we got some rate hikes here coming at the end of the 70s. And then we had to have a giant rate cut because we hit a recession. Now later in the 80s, again, hit a recession, big rate cuts. And then we can move forward here to the 90s, and we came out of this with rate cuts, but we didn't get a recession until a couple of months later after the yield de-inverted. Same here with 2000, rate cuts, got a recession a couple months later, yield de-inverted, again 2008, 2009, rate cuts, recession followed 3, 6 months, maybe 8 months later. 2020, that was short, that was a really one-off situation. And here we are today, really negative, really inverted. We need to come out of this inversion unscathed for a couple months for us to clearly say, hey, we've achieved the soft landing, we're all good. But right now we have a really big disconnect. Things are just starting to slow down, and we got market at all-time highs. That is an investment opportunity for us, or an opportunity for us to take some profits on some of the investments that we've had throughout the year, lock in some gains. All right, so we'll give you an update here in a couple weeks. Stay with us. Expertise you deserve, experience you can count on.